from Deloitte Tax and Legal Japan. Welcome to the Japan Perspective. This is a podcast where we speak to specialists from across Deloitte to discuss the latest business issues impacting foreign multinational companies in Japan. I'm today's host, Sho Unishi. Today's guest is Nicole Baxter. She's a director in an indirect tax services team in Japan and supports many large foreign multinational companies navigate some of the complexities surrounding Japan's consumption tax regime. Thank you for joining the podcast. Today, I would like to look at the latest installment in the evolution of Japan's indirect tax regime. Specifically, I understand that several measures that were introduced as part of the 2024 tax reform are now applicable. Is that correct?
Yes, thanks. Thanks for having me, Sho. Yes, that is correct. So specifically, compliance measures which are designed to tighten up the rules around the designation of Japanese consumption taxpayer status and the obligations that come with that are applicable to all tax periods starting on or after 1 October this year, so essentially just over a week ago now. Before I jump into the details, let me provide an overview of Japan's rules with respect to the determination of an enterprise's Japanese consumption taxpayer status. So Japan does not have a JCT registration system that we see in the EU or other countries with indirect tax regimes. Instead, taxpayers who are not registered as qualified invoice issuers are required to determine whether they are a JCT taxpayer. So that's an entity with a JCT reporting or remittance obligation, or a JCT exempt enterprise. So an entity without a JCT reporting or remittance obligation for each fiscal year using several prescribed tests under the JCT law. Now, within these prescribed tests exist several perceived loopholes, which the government is intent on closing in their pursuit to reduce the perceived inequality resulting from outdated laws.
So that is one of the reasons for the revisions, to stop abusive tax practices?
Yeah, that's correct. So maybe I can provide a little more context. Now, it's widely known that under the JCT law, in principle, a taxpayer is treated as JCT exempt during the first 2 years of its business life. This rule has been abused in many ways. So to stop this, the so-called specified period test was introduced some years ago. Now, under this test, if a taxpayer's JCT taxable sales in the first 6 months of the prior fiscal year exceeds a certain sales threshold, the taxpayer is not a JCT exempt enterprise. So therefore, if you had decent sales during your first year of business, in the second year, you would be a JCT taxpayer and required to remit JCT. In reality, however, this test did not work well when applied to foreign businesses who, instead of using the taxable sales amount from the first 6 months of the prior fiscal year, use the total salary amount paid to Japan resident employees to assess whether they had exceeded the threshold. Now, as we see from practice, many foreign businesses don't have offices in Japan and as such usually don't pay a salary to Japan resident employees. So essentially, by default, these foreign businesses could enjoy a 2-year tax holiday because of the loophole in the specified period test.
Okay. If you look at the specified period test first, can you please explain how this perceived loophole has been closed?
Yeah, so under the revisions, foreign companies won't be able to use the salary amount as consideration in the test to determine whether they're required to pay JCT in the current fiscal year. So instead, a foreign company must only use its taxable sales amount in the first half of the preceding fiscal year.
So by removing the salary criteria, foreign companies without a presence in Japan who are unlikely to pay salaries to Japanese employees may be treated as JCT taxpayers from the second year, if the taxable sales exceed the sales threshold in the first year.
Yeah, that's correct. So that's the purpose of the reform, to minimize the possibility of excluding taxpayers from the JCT net just because they have overseas business operations.
Understood. What other measures regarding designation of Japanese consumption taxpayer status have come into play on October 1st this year?
So these relate to what we know or are called the share capital and capital relationship tests. Now, traditionally, these tests are applied when an enterprise is considered to be newly established. So in other words, it's been operating for less than 2 years and has no base period. Now, in some instances, taxpayers were taking advantage of these rules to utilize the 2-year look-back rule and were able to avoid having any JCT obligations for several years. So to prevent this from continuing, the following revisions were proposed. So firstly, the share capital test. Under the old rules, a foreign company will be treated as a JCT taxpayer if its amount of share capital at the beginning of the fiscal year is above a certain sales threshold. Now, under the new measures, this test will apply to foreign companies during their first 2 years of doing business in Japan, even if they have a base period and are more than 2 fiscal years old. Now, the capital relationship test. So previously, to prevent taxpayers from establishing a new entity every 2 years through corporate restructuring, newly established entities directly or indirectly controlled by a person or persons with taxable sales exceeding a certain amount are excluded from the scope of exempt enterprises. Now, under the new rules, global income will also be taken into consideration. And if the related party's global income exceeds a certain amount, the tax exemption will not apply. So this test will also apply to all foreign entities, even those within the first 2 years of doing business in Japan.
Mm-hmm. I understand the measures just went live, but I wanted to ask whether these changes have already started to impact foreign companies doing business in Japan.
Yeah, so we're currently working with a number of foreign companies that will become JCT taxpayers as a result of these new rules that would not have been caught in the Japan tax net otherwise. So this has led to some foreign companies restructuring their supply chains, and others we're seeing incorporating local Japanese entities as they don't want to have cross-border indirect tax registration.
Shifting gears now, I think there was also some changes related to input tax deductions. Nicole, can you please just take us through those changes?
Yeah, sure. So the changes that you're referring to were made to the simplified taxation system, or as it's referred to in Europe, the flat rate scheme, and the small to medium business exemption. Now, prior to the changes, a foreign taxpayer could calculate its JCT liability based on a prescribed deemed purchase rate, irrespective of whether it actually incurred any expenses. But now, a foreign taxpayer without a PE in Japan on the first day of the tax period will not be able to apply either of the calculation methods. Instead, a foreign taxpayer must calculate its JCT liability based on the actual input and output tax amounts. So for companies out there that don't have a PE in Japan and are using these measures to calculate input JCT, these revisions may impact your business as early as FY 2025 if you have a December year end.
Thank you again, Nicole, for reminding us the latest changes in Japanese tax, consumption tax. And thank you very much to our listeners for tuning into this episode. Last but not least, you can find other episodes of the Japan Perspective on LinkedIn, Apple Podcasts, YouTube, Facebook, and X. Have a great day, and we hope you're listening to our next episode.